G'day everyone, welcome back to Pete's Investing. Today I'll be talking about the Commodity Channel Index 14 strategy, when to buy, when to exit, and also when to average down. But first, don't forget to refer to the channel playlists. That's where we review our strategies, our share price reviews, our indices. In the strategy playlist, we've got our simple trading strategy, the average down approach, and some money management ideas. Again, we're not offering financial advice, it's purely an educational video series on how to trade safely. Let's get started. So what I want to go through and what we cover in each of our videos is going to be looking at the entry strategy, obviously, the exit strategy. Now, that's not obvious because many videos out there show you a fairly good entry strategy, but they don't really tell you when to get out. So we're going to show you an approach that we use to get out of the trade safely and profitably. We look at the average down approach and the strategy used on that. You'll notice we don't use stop losses, but again, using good money management disciplines and some basic requirements in terms of what we trade, we're going to use the average down approach. We also back test our results on stock on a daily time frame, so looking at indices on the 15-minute chart and the FOREX on 15-minute charts. But again, each of these can be done on various time scales, but again, we need to understand what the funds are required and some money management disciplines are being followed. We also look at the drawdown and funds required and how that's going to impact you if you trade any of these and what happens if the market goes against you. And lastly, we'll look at the average revenue or estimated revenue for each of these. And as we progress through, some of these will be including brokerage costs as well. So let's look at the entry strategy first off. So what I want to look at first is a chart. And here we'll look at the US Swiss franc in terms of our entry approach. So let's just drill down on this little trade window here. And you'll see here, this is where we enter the trade. And that's where the CCI Commodity Channel Index 14 crosses above the zero. And we use a CCI14 is a nice time frame whenever we're looking at this, whether it's a daily or a 15-minute chart or even an hourly. So that basically looks at the last 14 periods or 14 bars. And what we're saying is when the CCI14 crosses above the zero line, we enter the trade. Now you'll notice in this example, the price went up and the CCI14 breaks down. The other criteria on our exit, that's the only entry criteria, by the way, is when the CCI14 breaks above the zero. Our exit criteria is when the CCI14 breaks below the zero. But the second part of the criteria is that this moving average, a simple moving average, has to start turning down. And here you'll see it's still in an uptrend. So we keep going, and we finally start turning down up here where the CCI14 crosses below the zero and the moving average 20 breaks down. That's where we exit the trade. So it made a nice little profit in that little trade there in about a day's, this is again 15-minute time frame, in a day's time frame. We're trading here, these little bars here indicate the number of positions opened, and here we've opened up one position. So we started here at a profitability level of 1621 and it closed out 1677. So it made about $50 odd, $60 odd in that little trade there. Now, why didn't we turn out earlier? Is because the moving average hasn't started turning down. The other part of the criteria is we must gain at least a nominal 0.5 percentage point profit of gain. So in other words, had the moving average turned down there, we still would have been in the trade because it hasn't gone beyond this window of profitability requirements. So the exit criteria is it must break below the CCI14 must break below the zero, the moving average 20 must start breaking down, and you must be above this profitability minimum gain before you break down. That's a simple entry and exit strategy. Let's look at another example where we average down. And what do I mean by averaging down? Unlike many other trading strategies out there, we don't use stop losses. Stop losses are okay if you're gambling and you're pretty much going a 50-50 approach into a trade. In this example, you'll see here the market went sideways. Now you'll notice as well, we entered our first entry there, our first position, indicated by those little bars there. The market went down, up, hasn't closed out because it hasn't gone up far enough. Then it started protruding down, went up, down, and so on. So we were in a pretty much a negative position here. It finally got down to this point. Now, where do we enter our second lot of positions? So here we had one trade entered, and here we've entered a second lot. So now we've got positions 2. We entered our second lot there. So we've got now 2 positions opened. And we finally close out those 2 positions at that point there. So why do we close out there? Now, first of all, why do we enter that position there and not back here? So yes, the entry criteria for an average down is the same as the entry criteria. The CCI14 must break above the 0. So why haven't we entered any more positions in any one of these areas? The main reason is this is 0.5% downturn. We want to enter when it's less than that, when the price has dropped further than 0.5% or a 1% drop from our entry position. So you can see here, it barely made it above there. These other positions were all above or within the 0.5 range. That's why it hasn't entered our second position there until it finally drops down far enough here. The CCI14 breaks above 0. We enter our second positions because that position there is lower than our 0.5 minimum drop. So we enter our second position there. The average price now is not up here on our first position. It's in the mid range somewhere around here. So when we start our second our exit strategy, it now kicks into play. Our moving average starts breaking up. Now here it hasn't broken. The moving average 20 is still breaking down, but it's still not. But that's still within our minimum gain range. Until up here, the moving average breaks down, and here it's just above our minimum minimum range of gain. So we break out at a profit. So you can see here, the exit profitability was 1941, and back here we entered on our first trade, 1879. So it made about $120 odd. Well, sorry, about $80, about $80 or $90 gain in that range. So again, within a few days, it's made that gain. Now, this is where you need to be very careful of your funds requirement. So let me just jump to the, this is the US Swiss franc example, the 1842. So if I go back to the chart, that's the total range from when we first opened back in late July on a 15-minute time frame. We made 1848. That's on a US Swiss franc, 1848. That is indicated by that number there, this is a live chart, by the way, so it's gone up a bit since we documented that. That's 1848 in terms of revenue. The maximum contracts was 19 entered. Now what I'm doing there is looking at the maximum contracts. So all these bars here indicated are the number of contracts entered. So here you can see this particular trade. Entered the first contract there, entered another lot there, entered another couple of contracts there, entered another lot there, and so on. Each of these arrows indicates averaging down until we averaged down and entered 19 positions, 19 contracts. That's indicated by that 19 contracts entered. Per contract value on this is $462 as of running. So 19 times 462, we're looking at 8,778. In terms of funds required in your account to trade that lot of 19 shares, 19 contracts. The maximum drawdown, 1369. That's simply looking at the highest point of profitability down to the lowest point. So let's assuming that was the highest point. That would be roughly from there down to there. So it looks at the highest peak of profitability down to the lowest peak. So that calculates in rough terms the maximum number of contracts open plus the maximum drawdown. So we're looking at maximum drawdown plus contracts about $10,147. So that's a profit over drawdown. So 1842 over 10,147 is 18% over that period. So again, looking at that chart, in terms of that big trade there with the 19 contracts, we opened up back here. Profitability opened up at 11.13. We closed out at 15.87. So I made just under $400 in trade in about just a bit over a month's period of trading. So that's a US Swiss franc trade as an example. So what I've done here, just to go back to the table, this here shows you, you can pause here if you like on the video, but this here shows you the entry criteria. The CCI14 must break above 0. The exit is when the M8, when the moving average 20 crosses down, and the minimum gain is gained, minimum profitability level is gained, and your average down when the close is less than the average price, and the same criteria as the open when the CCI14 breaks above 0, and a minimum gain of last 100 bars is gained. So it gives you a rough indication of how some of these other Forex trades went in terms of profitability, contracts, the dollar value per contract on CFDs, and how it performed in terms of profit over drawdown. We did the same exercise for the indices. This is looking at the US market, the Australian market, Germany, FTSE, China, and gold. Again, you can see there the different level of contract requirements required per contract. So I think something like China, we're looking at 14 contracts at 1,566 each, requires 21,924, whereas a small contract margin requirement for gold, you're looking at 22 at 89 per contract, total of 1958. So we just break it down and give you a daily revenue range. And lastly, looking at the blue chips, so we're looking at buying this is, instead of buying per contract, we're buying $2,000 lots of shares. So each time we buy shares, or bundle of shares, we buy $2,000 of each of these. You can see here the profitability reached, number of total contracts entered, i.e. in this example, if we bought Commonwealth Bank of Australia, we bought 3 lots at $2,000, that's $6,000. Plus a drawdown is 2,496, so total is 6,000 plus 2,496 is 8,496. So the revenue, 4,625 over 8,496 is 54%. And that breaks it down, because we're going back to the start of 2007, it breaks down to a monthly revenue, in this case, over 179 months, if today's date is the 28th of December 21. So that's pretty much it. We look at that's what we've covered. Again, we look at the entry strategy, the exit strategy, the average down approach, back testing on stocks, indices, Forex, the drawdown funds required, making sure you've got enough funds in your account to trade, and the average revenue estimated. So again, let me repeat that, the very important point, the drawdown and the funds required. If you look at the table again, again, as an example, let's assuming we traded these in the shares, going back to the start of 2007, you would have generated $39,000. If you traded $2,000 lots, you would have traded this many max at each of those periods. So again, let's look at Commonwealth Bank. You would have bought 3 lots of $2,000. So you would have needed at least $6,000 in your account, plus a drawdown. That's when the market went in reverse, went against you. It went down as far as 2,496. So you needed at least $8,400 in your account to cover that yourself for trading CBA only. The same applies for buying 1 contract each of these, and you bought 29 of the ASX, 19 of the US market, and so on, over the period since late July 21 on a 15-minute time frame. And lastly, the Forex, you would have bought 84 contracts for the Aussie US at $333 per contract, which is $27,900 for total contracts on margin requirement. So that's why I'm saying just make sure you estimated the funds required when you're entering these and averaging down. I did a video recently on putting stop losses in against the average down approach. Again, using good money management criteria, this average down approach works out better than the stop loss approach. Thanks everyone. Speak to you in the next video.